Good morning and welcome to Main Management's weekly market note. I'm Alex Varner, head of research alongside
James Maxwell, VP of Research.
Let's get into it. I think the biggest news of the week was the Israel-Iran escalation in, well, I guess it's not escalation, it's overt hostilities.
Yep.
Israel going in and doing a number on Iran from what it looks like, where they took out several of their top military leaders. They started going after the nuclear facilities. I think the biggest concern, immediate reaction in markets was oil was higher. We'll just touch on this performance quickly, but more things kind of down than up at the end of the week because of that escalation. Recession dashboard relatively unchanged, but here's the Israel-Iran picture, and the biggest move was the surge in oil prices, up 7-8% on obviously concerns around Iran supply. I think it seemed like the markets were not pricing in a closing of the Strait of Hormuz, which would have been a worst case. But now we've got news this morning that I guess Iran is maybe saying, "Hey, we want to come to the table and stop the attacks."
Wanting to negotiate some of the nuclear talks, and overall, just what the headline was signaling it wants to end hostilities. So, very clearly wanting to resolve what's been going on. Which is a positive. It's kind of over before it really even started. The last thing you want for a lot of geopolitical stuff is for it to kind of go on and on and on for months or years. So the fact that it was kind of roughly a week is a good thing overall.
Yeah, I mean, pieces we're talking about, is it a regime change? Is it like, what is the kind of the way that this piece will play out? How is it going to be shaped by the U.S., by Israel, by the other players in the Middle East, who most of them are not huge fans of the way Iran has been operating? But I think for the time being, you've seen some relief in the market, certainly this morning, Monday morning, as it seems as though this thing is probably certainly closer to an end than it was even 2 days ago.
Yeah, we'll see how it plays out, but positive news this morning.
Yeah, certainly on that. So when shifting back kind of to the data from last week, we got the CPI figures. May's headline reading was in below forecasts again, up 0.08% month over month. Core was in cooler than expected at 0.13. Year over year, the headline ticked up to 2.38. That's because of the tough comparison that rolled off. But again, this is kind of that moderating disinflation trend remains intact, especially true on the core side, where core slowed to 2.77, which is the lowest since March of 2021. Again, next month, the June readings, which we get, in mid-July, it is a tough comparison. So you might see that year over year figure. But again, when it's due to tougher comparisons as opposed to kind of increases in the underlying basket, that's certainly something that people are able to look through and say, hey, this is just, it was low last time. It's thus a little bit harder for it to continue to come down. But basically, the long and the short of it is tariff signs have been pretty muted so far.
Yeah, it's really interesting to see that the tariff impacts. This is really the first full month of a lot of these tariff impacts, and a lot of people were watching it as kind of the first sign that they were really inflationary, and there's kind of this risk to the upside, even above that 0.2% estimate or consensus estimate. But you saw that they came in below, which I think shows that tariffs might be they're more importantly like contractionary to the downside, at least in this case, in terms of kind of growth, than they are inflationary to the upside. There's kind of those two offsetting factors where are people buying things even though prices are higher. So we'll have to see with the months going forward and the other inflation readings, but it's a positive sign.
Yeah. And on the, something we've looked at is a lot of potential was paid to the goods side, because this is tariffs applied to goods. And this has actually been outright deflationary for 3 straight months. Goods were down 0.12% month over month. They're flat year over year. Food was a little interesting. It was deflationary last month, but rebounded to plus 0.29% in June. That, is an acceleration. That year-over-year trend is continuing to grind higher. It's up to 2.9. We kind of started that uptrend back in August of 2024 and have just been grinding higher since then. As you can see on the right there, those light blue bars, you've had one down reading in food in the last 4 or 5 years, which is not ideal, especially because that's where consumers acutely feel price increases. You heard all the headlines on bacon. Like, can we, again, not going back there, but basically people are very, very aware of the prices they're paying for goods. And this is definitely source of areas where they will look to substitute or replace, if it's, beef versus chicken, certain products, going to Walmart or Costco versus going to Whole Foods. So it's certainly something to keep an eye on.
It's also one of those kind of industry dynamics that I'm sure we'll continue to see with tariffs, where certain goods, certain industries are able to kind of, look through them or have substitution effects where they're not all that big of an impact on the end consumer's prices. But maybe food is one of those that's more sensitive, where the prices kind of directly flow through from any tariff or from any.
And it was interesting. One of our senior partners mentioned on our morning call this morning, steel tariffs have an impact on it because of canned goods.
Yep.
And you think about that sort of thing, where even though it seems like it's this tiny little sliver of steel around the the aluminum can or the tin can, but if that's up 25%, that cost of that can does the company eat that? Do they have to do the consumer? So it's all these sorts of different areas where it's not just the consumable goods, it's also the way they're packaged, especially when you're talking about, kind of preserved longer term things like that.
Yep.
Moving over to the PPI, the producer price index. This kind of has a tendency is looked at as leading CPI. So almost, and if you remember last month, PPI and CPI came below. This month, CPI came in below, and PPI did as well. So that's a good sign, kind of looking forward again, where its producers are kind of the intermediaries between, the importer, exporter, and the end user, where they are the ones kind of packaging, making the goods into consumer-ready products. And so if you see price increases there, it may mean that they are looking to pass them through. But again, we're not seeing that here on the left. Overall PPI, it was up for the first time in 2 months, but again, came in below forecast at 0.13. Core on the right, up, less than expected as well. And so those year-over-year figures are also kind of turning back down. And you saw they've been grinding higher for the last 2 years or so. So to see these kind of turn back and roll back over and head towards 2% is a good thing.
Yep.
On the right again, on this slide here, goods and services. So again, the goods rebounded a little bit. Services did as well. But the whole point is those year-over-year figures have kind of turned to flattened out. Services are really slowing down on the year-over-year. Goods a little bit less so, but that choppy trend to the right, it's up 1.4%. So again, that's below the 2%, and this is kind of lumping everything into that 2% target.
Yep.
But the components aggregate up to that, and so if you're looking at this below the level there, that's a good thing. I think we've seen, the optimism or sentimism or however you want sentiment. That's a new word for us. Have been pretty beaten down.
Yep.
The NFIB number. This is the Small Business Optimism Index. The headline index is on the left there. It unexpectedly rebounded to 98.8 in May. That's one of the highest levels since before the election. And you saw this thing spike after the election as businesses were like, great, regulations going away. We're going to be able to operate. And then the tariff talk came on and they go, oh, shoot, this is not good.
Yep.
So to see that rebound is a good thing. Again, one data point doesn't make a trend, but you can see hopefully we're at least moving off of that recession level that we were at. That red line there is the recession median. And we were just mired in that area for 22, 23, most of 24. So to kind of move structurally off of that is nice. And if you look back a little bit, the current levels, even if we were to settle here, it's above, 12, 13, 14, 15, which is a good thing. You want to kind of see that. And on the right, one of the things that has been closely looked at, again, coming back to tariffs and inflation, is the prices. In May, a net 31% of firms reported that they're planning to raise versus lower prices, which is the highest. So that means that they are passing them through. That's not great for consumers. Again, this is plans, not necessarily reality, where if you say, hey, they're putting this tariff on, and then you ask them the question, are you going to plan to raise prices? They probably say yes. But if that tariff comes off, then the price increases don't go through. So that's something to keep an eye on. And then kind of unchanged versus the prior price changes over the last couple of months. But still, not great. It's above pre-COVID levels.
One thing on the inflation side, and especially like the plans to raise prices, that's different from call it like 2022 or 2021, that kind of era of inflation. These tariffs are inherently kind of able to be changed, and we've seen that where things can be taken off or added on, and that makes planning much more kind of flexible or in response to the data. Versus in 2022, if they're planning to raise prices, there wasn't really much to like change that plan. There wasn't suddenly like lower.
It was like a supply chain issue.
It was purely just a supply chain issue that was not getting cleared up anytime soon. or just broadly like oversupply of money where they needed to raise prices because they needed to run their business versus
Yeah.
this is like in response to policy, which policy can and will change.
As we've seen.
Yeah.
One other thing kind of coming out of this NFIB was maybe we're seeing a decline in uncertainty.
Mm-hmm.
This kind of is reading through the data here. But on the left, you see capital expenditures, and on the right, you see sales. And these are plans and changes. And the point of this whole thing, this whole slide, is basically that you were seeing plans for capital expenditures increasing. It means more companies are planning to do capital expenditures than were, and they're also more optimistic about the sales environment. And relative to the past 3 to 6 months, compared to present, things are less uncertain than they were. So hopefully you're maybe seeing a little bit of this overhang, and the companies, this could even be as simple as, we're not saying the tariff picture's cleared up, but it could be as simple as companies saying, hey, we recognize this is far more fluid than we thought. We can't all of a sudden assume the worst and planned around the highest tariffs, because we've seen that these, as we mentioned, their policy, they can be repealed. So that kind of opens up and helps you think a little bit more, maybe be a little more optimistic around the coming months here.
Yeah, I mean, it's the number one thing for any sort of business planning and markets in general is just like uncertainty is not a good thing. And you've kind of seen the clouds start to clear on a lot of the tariff uncertainty side. And that's reflected in their sentiment, reflected in their kind of readings on these surveys saying that, hey, maybe we're a little less uncertain about our plans. And yes, it's still there, but it's less than it was a month ago or 2 months ago.
And the important thing is kind of the direction of the change here. It's not necessarily the magnitude or the absolute level it's at. It's just, hey, it's getting better than it was. And you got to start somewhere to kind of start getting back to normal. So hopefully you'll see a continuation of these trends going forward. I think one of the last things we had here to finish out the week was we got the preliminary reading of the Michigan Consumer Sentiment Index. Again, more positive than expected. This thing hit 60.5, well above expectations for a 53.5 reading. It's the biggest monthly increase since January of 24. You saw current economic conditions improve, expectations index improve to the highest levels in a couple of months. And then on top of that, you also saw the inflation expectations decline. And I think those kind of go hand in hand. When inflation expectations decline, people are going to feel better about it. The point here, though, is those things had run up to the highest levels in decades. And to see them start to pull back a little bit is a good thing. Clearly, I think that was pushed up by the tariff fears and people saying, oh, well, now we're going back to 6%. Because 9% inflation is still very much in people's minds. That was only 3 or 4 years ago. And so to have that, and people hear, oh, expectations are coming, inflation's coming, they go back to the worst case scenario. And to kind of see that abate a bit is a good thing here.
Yeah, I think you're going to continue to see a lot of these kind of sentiments or surveys in general. You have this spike, out of whack, either upwards or downwards, depending on what you're measuring, in the past couple of months because of the tariffs. So in this case, you saw a sentiment kind of collapse March, April, and then it's bouncing back here as a lot of that uncertainty, a lot of that bad sentiment, all of that, starts to clear up with the deals, with kind of pulling back on some of the aggressiveness that the administration had. So yeah, it's kind of funny to watch how quickly these things reverse or change course.
Yeah, people can really get whipsawed emotionally when it comes to prices and fuel prices.
Part of the thing too on these surveys is people are not stuck to their opinions. It's not like they're making a buy on a stock and they have to hold that. They're asked how they feel. They respond. They go about their day. They don't care how.
They don't think. Oh, well, last month I said I was pretty unhappy about everything. Like maybe I should be consistent with that. It's like, how do I feel the day that the guy calls me?
Yeah, exactly.
Yeah. So I think that sums it up. As we mentioned, we're getting real time developments on Israel-Iran situation. Hopefully, it's maybe headed for at least in the right direction of some sort of resolution here. Again, PPI and CPI came in below forecasts. That should feed well through the PCE reading at the end of the month as well. And we've started to see sentiment maybe shift for the better with that NFIB figure and the preliminary University of Michigan. This week we get retail sales, industrial production, and housing starts. Those are kind of the big data points as we head. And then I think the following week, the big one is going to be that core PCE
you also
figure.
Have the Fed meeting this week.
That's true. And they are basically expected to stay put.
It's expected to be pretty uneventful, which is a good thing. I think the biggest thing to watch is, as always, the language that Chair Powell and then the subsequent kind of members after the meeting, how they talk about what they've seen. And I think our view is that they'll see that inflation's continuing to come down. There are risks in the labor market. Hopefully they kind of see that there are opportunities to cut. There's still to expected. If you look at Fed funds futures, two cuts this year, and we'll see if those kind of move around. But that's kind of where we stand as well.
Yeah, they've been kind of at 2-ish cuts,
Yep.
as we call it, as you call it, through the balance of the year. So I think that about sums it up for us
Yep.
this week. Thank you for taking the time to sit down and talk through the market note, and we will talk to you next time.
Great, thanks.